Good evening, everyone. Welcome to this webinar on how to capture the big moves using volume profile. Today we have with us Abhishek, who is going to take us through this webinar and going to tell us how to identify the market structure and decoding the price volume relationship, how to leverage the power of volume profile to capture the big moves, and how to avoid false breakout and breakdowns. So, welcome, Abhishek, and thank you once again for obliging us with this particular webinar. We are all looking forward for your insights on this. Thank you. You can share your screen and start the webinar.
Hi Roshan, thanks for the introduction. Good evening everyone. Welcome to this session. A quick introduction about me. I'm a professional trader in the markets from the last 8 years. A lot of you are already associated with me through either Quantower or through my Telegram channel. For those who do not know about me, my primary specialization with respect to trading is day trading and short-term positional trading. I mainly focus on the indices, Nifty, Bank Nifty, and Nifty Financial Services for now. And my area of specialization when it comes to technical analysis is volume analysis. I primarily use volume profile and order flow analysis for my trading. Apart from that, I also use my own proprietary indicators, which I have developed and are available on Quantower. Even I use them for my trading. Now, for those uninitiated, let's have a quick walkthrough through about volume analysis before we deep dive into the topic. I have only one condition about this webinar, that if you have any questions relating to the topic on what we are discussing, please make sure to ask me in the chat box. Can everyone hear me clearly and can everyone see my screen? All right. So what is volume analysis and how is it different from price action? This is a question that I get a lot from a lot of traders is why volume, Abhishek? Why volume, Katie? Why do you exactly focus more on the volume analysis of it, but not on the price part of it? Well, price needs to have a catalyst to move. There has to be what exactly moves price. It is volumes, the buying and selling activity into the markets that actually moves price in a certain way. Now, we have buyers and we have sellers at every point of time. The market basically functions on a dual auction mechanism. The primary purpose of markets is to facilitate auction. That is, stock market from a technical sense brings your buyer and seller together to a platform, and it is up to them to exchange what they have. Whether someone wants to buy, they buy. If someone wants to sell, they sell. Now, within this entire process of buying and selling, since this keeps happening at every second, every tick that the market is open, the movement of the market at a particular location depends on the volumes itself. What exactly is happening in the markets at a point of time? Is price at a location where buyers are in control, or is price is in a location where sellers are in a control? Or if price will move from a particular area, are sellers going to get trapped, or will buyers get trapped at this location? If these are the various perspectives that I like to look at the charts, I like to look at a stock or an index from this perspective, because this will open up a lot of opportunities for you as a trader, because it's critical to understand what is happening in the market and why is it happening. The up move that we saw yesterday, for example, is this due to fresh buyers coming in, entering the markets at higher levels, or is it purely because these sellers here exiting their positions? When you understand things like this, when you have a clarity on the flow of volume that is actually triggering the movement of price in live markets, this this will open up a whole host of opportunities for you, both in analysis and also in terms of trading. Any queries so far? All right. Now, before we proceed, regulatory disclaimer from my end. Please note that all the contents of the webinar and after this is only for your learning purposes. I am not a SEBI registered advisor, and I am not advising anyone to buy, sell, or hold securities. Before you transact in the financial markets, make sure that you consult your financial advisor, since it's very risky. Now, now that you understood what is volume analysis and why exactly do you use volume analysis, there are multiple ways to use volumes in the markets. A lot of traders use their favorite volume indicator is the underlying volume tool that you see here. One moment, let it load. This particular indicator. This also talks about volume. Volume profile also talks about volume. So which one to use, or why exactly do I use volume profile? The major drawback with the underlying volume indicator that you are seeing below here on my screen is that it only talks about volumes at time. That is, you see this particular candle. If you put a 15 minutes time frame, it will show the volumes on a 15 minutes time frame. And if you put a 5 minutes time frame, it will show you the volume on a 5 minutes time frame to you. But it doesn't talk about the price movement itself. For example, if you see this large bar of volume in this candle, the candle is a large one, the volume bar is also a large one. Let us say if 10,000 contracts were traded in this particular bar, just an example. Now, within the entire bar, at what range were the maximum contracts traded? Like, for example, the bar stretches from 45,300 roughly to 45,550 in a 15 minutes time frame. If out of these 10,000 contracts, 70-80% of the contracts are transacted to the highs, and then price is again coming below this area, then this is not a bar on which you can rely for support as a trader who's having a long position here. So this kind of insight, or this kind of dissection into the price volume behavior is not provided by the regular volume indicator, which is why it doesn't provide any added edge to a trader, especially on shorter time frames. As a day trader, someone who trades on a 5 minutes or a 15 minutes time frame, this doesn't provide that much of information, which is where your volume profile comes into picture. In Quantower, this is a 15 minutes chart with a 3 months time range. Here I go to step profile, I go to volume and choose the time frame as a day. That is, now I use volume profile on a daily price range. Understand that there is a difference between price range and time frame. Here my time frame is 15 minutes, but my time range is 1 day. That is, I would like to see the volume traded at every price level on a daily basis. That is, for example, today price traveled from, it opened at 45,750, made a high of 45,925, and then made a low of 45,356. So within the entire range of 45,925 to 45,300 odd levels, price moved during the day. It tested a particular level multiple times. It tested a particular level only a few times. So the entire journey of price that a particular index has undertaken over a day's time range, I would like to see the volumes that were traded at each point of the price's journey. That's exactly what volume profile is. You can use it on a weekly time frame. You can also have monthly profiles. I primarily like to use daily profiles and weekly profiles, and right now I'm using volume profile on an interval of 1 day. So what exactly does these histogram show me? What exactly does these horizontal bars show me that you are seeing here? Let me change the color. So here you can see that at every price point, at some price points, the bars are longer. At some price points, the bars are shorter, like here. And at certain instances, you are seeing that the red color is dark, and in the other case you can see that the color is lighter. So what exactly does it mean? This tool basically shows me the volume distributed, as I said, at a particular price point. Now if I look at 45,000, I see a good volume bar at 45,000 for 500, sorry. 45,500 price level was visited by price in this candle, in this one, in this one, 3, 4, 5, 6, 7. So this particular area was visited by price, let us say 10 to 12 times during the day. So every time when price visits a particular area, the volume that was transacted at that area gets clocked in as per your volume profile here. This bar shows me the total volume transacted in this area over one day. It doesn't matter how many times price visits that area here. Its job is only to show the volume. So here you are removing the time factor. Did it happen on a 5 minutes? Did it happen on a 15 minutes? You don't look at that, but instead you look at the volumes traded at a particular price point. And the red color area that you see, the darker red, represents 68% of the highest volumes that were traded during the day. The dark red area represents 68% of the highest volumes traded during the day, and which is called as your value area. Now, why 68%? Why not 75%? Why not 80%? Because the rule is based on the Gaussian curve of standard distribution. You can Google it later and it will be clear for you what the Bell curve or the Gaussian curve. The yellow part, the yellow line you see here is called as your point of control, which is the single price point during the day where the largest volumes are traded. The borders that you see is called as your upside border is called as your value area high, and downside border is called as your value area low. Clear so far? Everyone with me? Why 68% on one side? Why not other side when dark is up or down? Well, 68% of the highest volumes is what is shown by your value area. Sometimes the highest volume can be transacted at the upper end of the day's price, or sometimes at the lower end, or sometimes in the middle. So wherever that happens, you would see that the area is colored darker and value area is shown to you. Now, what are the implications if value area is to the upside or value area is to the downside? We'll come to that in a moment. Now, so far clear? So using this information, using this particular piece of information, you can analyze the market structure, and most importantly, you can understand what is the price volume context in the markets as of this moment. And are we at what kind of a price location are we at? Let's first talk about something called as the profile shape and the closing structure. Profile structure and the closing, sorry, profile shape and closing. Is my screen clear now for everyone? I have a considerably larger screen, so if you see that the size is too small, you see a lot of information, let me know. Okay. Now, every day price opens at a certain point and then closes at a different end of the range. Could be at the same area, could be at a different area. That's totally random. Now, once you see that a day's session is done, for the next day, you can always look at the previous day's volume profile structure and the closing of the price to draw certain inferences, to understand certain pointers, and what to expect from the market the next day. So what exactly do you look at when you see that the price is when you see that the markets are closed at a particular point of time? Let's move to 5 minutes time frame, because we are dealing with intraday and it will be more clearer to you. Let the profile load. Now, if you look at the profile structure of yesterday, where do you see now? Look at both the profile structure and the price movement. Price opened at a particular area and then it rallied throughout the day and closed at highs, right? Now price is closing at highs. Price is closing at highs. Where is your value area? Where exactly is the volume structure? Do you see value area also at the highs or value area at the lows? You see value area at the lows. Now, what does value area represent? Like we discussed a couple of minutes back, what does value area represent to you? It represents the highest volumes, that 68% of the highest volumes that have been traded at a particular period of time, be it a day or a week. Now you are seeing closing at highs, which tells you that the trend is bullish. But where are the largest volumes traded? They are present far below your closing. Now, if the largest volumes are traded somewhere in this range, these are the extremes of your range, 45 to 50. And because these are obviously a lot of them are long positions for you, because the market rallied and closed at highs, the trend is bullish. The closing is at 45 500 and you see the volumes at 45 200, for example. Do you think that if some opposite party comes here, if someone starts selling at this location, these buyers who bought, let's say, at 45,200 and 44,900 will have enough intent to defend their positions? Say you buy a stock at 1,000 and the price goes to 2,500, comes back to 2,300. Will you bother? You will not bother unless it comes to 1,200 or 1,300. That's the same way here. When the long positions have been deployed at the particular price location and a particular up move is done, as a day trader, the next day when market opens at such a location, and if you enter a long position, a long trade here, you are not entering based on the backing of large volumes, because the largest positions are placed somewhere at 45 200 and you are taking a trade somewhere at 45 600 long position. Sure, is a trend to the upside? Yes, the trend is to the upside, but are you at the proper location? Is price at the proper location for you to open a fresh long trade? So if someone opens a long trade at 45,600, then their stop loss should be below 45,200. This kind of a structure where price closes on one end and value area is to the opposite end are basically weak trend structures, where price closes at one end, that is in this case price is closing to the upside and value area is to the downside. These are called as your weak trend structures. And in such cases, when you see such a structure on the previous day happening, the next day it will always pay you better. It will always pay a trader better to focus on entering at pullbacks towards the trend if you are a trend follower, rather than chasing breakouts or breakdowns. Is that clear? Or any questions? Anyone? Any questions? Someone says, can you repeat? So when using volume profile, when you see that, the price closing is at one end and your value area is at a different end, that is the price, the closing of the price and the value area is not at the same location, is not at one extreme. That is, in this case, price opened at point A and then rallied all the way, went up, but your value area is still lower. When you see such a structure for the next day trading, in 8 out of 10 cases, it will not pay a trader to chase breakouts. There will be those 1 to 2 times when there will be a continued breakout or a short move, but more often than not, this is the kind of structure or the play that happens. And this was something that I had explained, I had shared today morning in Telegram as well, that the buying in Bank Nifty is weak and we need to see fresh buying to take prices up. Because when I see that the largest volume positions are at 45,200, they have no business mounting a defense if sellers start coming in, say at 45,800 there. Is that clear? Not clear on value area. पूरे दिन में किस price range में 68% volume trade हुआ? There will be many price ranges with 68% of overall volume. No, I am talking about the entire day's price range, Utkal. That is, if price, say for example on this day went from 44,800 to 45,400, इस पूरे rally में जिस location पे 68% volumes trade हुआ, that is shown by your value area. So now that we've discussed about weak trend structures, where one easy way to identify weak trend structure is this way to look at the closing of price and the value area, the value area relationship to closing. Let's talk about what are some strong structures where you see that there is a stronger presence of a trend where a trader can actually look to trade breakouts or focus on breakouts. One simple example for that is your relationship between 14th and 17th. When you see that the closing of the price and value area is to the same end, to the same extreme. Here you saw that closing is up to the highs and value area is not at the highs. Here you are seeing on 14th that your closing is at the high and value area is also at the high. These are the kind of days where trading breakouts would be more fruitful. These are the breakouts on which you can basically trust. This is a step one of having confidence in trading a breakout. There are, of course, a couple of other parameters you can always look at, but step one of understanding whether a particular breakout or breakdown is going to be strong one or a weak one, or you will get better risk reward by entering at pullback, is understanding this kind of a structure there. Clear? Pick the day before again. Price is closing to the lows and your value area is to the upside, opposite of this one. Here you saw that price is at highs and value area is below. Here you are seeing that price is closing below and value area is to the upside. Whenever I see such a structure, I don't carry overnight positions in the direction. That is, price opened, went up, and then closed. There will be a lot of anticipation towards a short-sided move the next day or a gap down opening. These are the kind of structures where a trader can avoid carrying overnight short positions, but instead wait for market to open so that they get a better opportunity to enter at pullbacks into the value area. Here, for example, this is where we opened. Is that clear? Or any questions?
Abhishek, can you draw today's value area and show to some people are asking questions regarding that? So
Today's value area,
yeah, just show them area so that they are clear about it.
this is today's value area. If you look at the price volume structure at this point of time, this is 18th and tomorrow is 19th. Say tomorrow we open with a gap down. Tomorrow we open with a gap down and start moving down. I wouldn't prefer, for example, to chase shorts at this point of time until at least we take out 45 to 20. When price will start accepting below 45 to 20, the my most recent value area high from where a good move came, this is where I'll put on a short. Or rather, instead of chasing shorts, if we open with a gap up, for example, then I would be more than happy to short. Say for example, if we open with a gap up and test today's point of control at 45,740, or we open with a gap up and start showing some rejection at 45,500, these are good locations to short. Value area and close at high, as you mentioned, but next day market opened and came down. Sometimes it happens. As I said, 2 to 3 out of 10 times it can happen. But what exactly do you do when it happens is the point. What do you understand from it? For example, at this point of time, for here, you see that price closed at highs and the value also is at the extreme end. And when price started coming down, previous days buyers started putting up a defense at your value around your value area lows. Now, sometimes sellers will take control of the markets here and then push price below your previous day's value area low. So what do you understand from such a context? If you have clarity on what is happening, what will you understand if price breaks down? That we have a lot of buyers in this location, but they are unable to hold the prices up. So if price breaks down, what will these buyers do? They are going to liquidate. They will be forced to liquidate their positions, which will trigger a strong down move. Is that clear? Anyone, any other queries? Roshan, what was that about today's value area which you wanted me to mention?
No, somebody was asking a question, show me the value area. So I told him to
Okay.
show. That's fine. You already explained, so no problem.
Now let's look at Nifty's chart, for example. Now let's look at Nifty's chart, today's context. Market closing at highs, and then your value area is also to the upside. Which index showed comparatively more strength today, Nifty or Bank Nifty? Your point of control is also at highs. Do you understand now? All clear? How frequent the value area and demand zone will get changed, also reflected or also getting reflected in those two Quantower. See, value area is plotted on a real-time basis by the software depending on the volumes transacted. That is the reason why, as I said before, for today's trading session, I primarily look at previous day's value area, and for a particular week, if you are trading during this week, I refer to my previous week's value area than the current day's value area or current week's. Why? Because every trading session is an extension of the previous day's session. Nothing happens on an individual basis. The positions that were the players who built positions yesterday will show a reaction to price movements as they did when price came here. So every trading session is an extension of the previous day's session. Plus, say for example, at 11 o'clock, you are seeing this is where your value area is an example and price is moving up. If you have to look at the weight of evidence, will you give more importance to price and volume of 2 hours or price and volume that occurred on an entire day structure? As a trader, will you give more importance to the price and volume of a day structure, a day that has already been done, a day that has already been established, than today's volume structure that's just 1 or 1.5 hour old? Entire day structure. That is the reason why I focus more on the previous day's volume profile, when these provide very good locations and context for you to understand. So volume profile available in Zerodha? Nope. When market profiles POC and VPOC or value areas have big difference in values, and which one would you follow? Today market profile POC is 45,500, whereas volume profile point of control is 45,740. I personally follow volume profile only. I do not look at market profile. Right now, one more kind of a profile structure that will help you avoid choppy days, for example, for the next day's session, is something called as a balance profile. When you see that the value area in the previous cases, on this day, the value area is towards one extreme, to the upside. On some days, value area is to the lower extreme. If you see that value area is right in the middle, or it is not at either extremes, that is, it's not at the lower extreme or it's not at the upper extreme, this is called as a balance structure. So this is a day where neither buyers nor sellers showed total intent to control the prices or to drive the prices. When I see that such a profile structure occurs on a particular day, then as a rule of thumb, if you are a breakout trader or if you are a breakdown trader, then you should not be chasing breakouts or breakdowns until this period's high or low is accepted. That is, unless price trades above the high, previous day's high, or price trades below previous day's low. Because for next day, exactly, Uday. So tomorrow, if market opens within Nifty opens within today's range, the range of 18th, I wouldn't be chasing a breakout or a breakdown unless I wouldn't be taking a directional bet right in the middle when prices, unless price breaks 19,700 or 19,825. Instead, these are the kind of day where you can focus on mean reversion trades. That is, if price comes down to my previous day's low at this point, this will be a very good location to focus on putting a long trade. If price goes to this area, this will be a very good location for me to focus on putting on a short trade at this point of time. Because these are also the last lines of defense for a buyer or a seller, because agar iske upar price jayega, then that will be converted to a trend day, essentially to an upside trend day. So very good from a risk reward perspective. These kind of trades are personally my favorite kind of trades, that is entering at pullbacks. So far, is it clear? All right. So how to identify if you can expect a larger move in a particular period of time, whether it is a day's time or a week's time? How do you look at it? How do you know whether this day is for playing reversal during market hours? That's what I explained to you just now. I'm not going to be using these references 19700 and 19800 for today's trading. These references have been established by today's close, so I will be using them for tomorrow. So how to identify if you can expect a larger move during a particular time frame or a time period? There are certain ways using a volume profile analysis. There are basically two methods using volume profile analysis where you can have a good expectation of whether the markets are going to give a larger move or if the markets are going to stay in a particular range. And please note that you can use this analysis as a part of your existing arsenal, because if I start covering the exact rules for entry and exit, it will take at least a couple more hours talking about various scenarios. So use this as one of the multiple pointers in your analysis, especially for understanding market structure and market context, and it will help you. This is my weekly profile. That is, I'm looking at volume profile on a weekly basis. Let the profile load. Now the profile is loaded. One simpler way is to see on a weekly basis if the week is in a balance. That is, if a particular week's profile structure was in a balance, that is neither buyers nor sellers took control of the markets completely. We did not see either one side taking total control, but instead there was a neutral condition. What did we discuss about balance profile some time back? That is, you see the profile structure neither at the upside or to the downside, but right in the middle. Is it clear? Whenever you see that 2 weeks structure is balanced, you can also use for 1 week, but more often than not, when price goes into balance for a week, it tends to continue. If price is in a balance on a weekly profile for 2 or more than 2 weeks, bare minimum 2 weeks, in the past it was also there for 4 weeks, and I think it was at the lows, the before the lows that were printed after the Ukraine Russia war news. At that, during that range, price was in a balance for 4 weeks, and then you started seeing a breakout. So if you see such a structure forming on 2 weeks, this is your week one, this is your week two, you could see the kind of the move that markets are giving at this point of time. You could see the magnitude of the strong move that culminated in the current week. Now, how do you spot it? How exactly do you focus on it, or how do I say it? How exactly do you capture it in your execution? What should be the trigger point? Now, I personally use two trigger points. One, if at all it's on an overnight basis, previous week's high. I'm talking from a directional perspective. I'm not talking about traders who are taking trades from a BTST point of view. I'm talking about traders where they are comfortable holding positions for at least 3 to 4 days, not blind BTST. Above previous week's high when there is a balance, or if it is on an intraday basis, above previous day's high to the upside. If it's the downside, then previous week's low and previous day's low. This would be my trigger points. If you are a very aggressive trader, if you are an extremely aggressive trader, when you see that the previous week's structure is in a balance, then when price reaches the balance areas low, when price tests your balance areas low, that is when you can take a position as well. Basically the pullback entry that I was talking about a few minutes back. But again, there are no free lunches, as I always say. If you are going to take a position in a very aggressive fashion, then you should also be ready there to aggressively take stop losses when it happens. For example, this week we were in balance. In week 2, when price tested this area, here initially someone could have taken an aggressive long entry, but then that would have hit stop loss. This is why I say if it's an aggressive way of trading, you should also be ready for stops to be hit aggressively, because there are basically no free lunches. The higher the reward that you want, the corresponding risk you would need to put on there. But if for the moderate traders or someone who wants to trade in a steady way, then the rule that I would suggest is a 2-week balance, minimum of 2-week balance, and then to the long side previous day's high, previous week's high for positional, and previous day's low and previous week's low to the short side. Clear? Can we use directly your app because trainer Shivu, I did not get your question. All queries clear? Everyone. Now, one alternate way of identifying, this is something that I also shared on Twitter yesterday, is talking about the concept of trapped traders. A lot of order flow and volume profile practitioners have the habit of using something called as delta. And more often than not, the bias would be that the way of using delta is that, for example, if I open order flow chart, that you look for a large number in delta or cumulative delta. For example, here the markets are moving up, you see a large delta, then it implies that buyers are in control of the markets, and if there is a large negative delta, then it implies that sellers are in control of the markets. It doesn't work that way. One should not use delta that way when using order flow. There are other ways and other techniques to do that. Now, one way of using the delta is to use delta volume profiles in your analysis. This is also a very good way, especially if you are not a hardcore volume profile trader. This will help you out. If you are not a hardcore volume profile trader, then this will help you out. Now, you can use delta profile on a day's time frame or a week's time frame, your wish, but I personally would suggest that you use delta profiling on a 15 minutes time frame from your previous swing high to your swing low. If you have a fair idea of price structures, then use it from swing high to swing low. Now, what do you use it? What exactly is delta? Here, I'm not talking about the option Greek delta. Delta, when it comes to volume analysis, basically is the difference between the buying and the selling volumes at a particular place. If it's a positive delta, it implies that there is more buy side volumes. If there is a negative delta, it implies that there is more sell side volumes. But buy volumes doesn't mean market is going to go up. Sell volumes doesn't mean market is going to come down. It's not that easy. If it were that easy, then we would all be have our lives in a much lead our lives in a much more easier way. So this delta can also be used on a particular range of price. That is, in this case, for example, I am using my delta from my swing high recent swing high to the pullback area. For example, if I use, let's say that price is pulling back and you see that this particular move is happening. So what do? Go to custom profile, plot delta profile over a price range. Go to volume, change it to delta here. Look for the price area of high delta bars. Now, the reason why this is important is because, as I always say, I'm zooming in one moment. As I always say, you need to look at things from the opposite party's perspective always. For example, if price is moving up at this point of time, what will all these guys who sold here do? Everyone who started loading on short positions in the last few days, what will these guys do? They'll have to pack their bags and exit. Now, if you I understand where were the most aggressive shorts present using delta. As I said, what is delta? The delta is your difference between buying and selling volumes. If you see that someone has placed a large short position, see the length of the bars here. See that someone has placed a large short position, and when price is breaking out through their area, what is this guy who put on the large short position here do? Because this short was deployed during this price movement, and right now price is moving to the upside. So what will this guy do? He will have to get out of his trade. And what does that trigger? That will trigger a strong up move. That will trigger a further up move. Basically, short covering to the upside and long liquidation to the downsides. This gives you a much more stronger move than actual trend following trades. What does this guy do once price breaks out of here? He has to pack his bags. Simple. Now, when price is again coming down, if you look at it, where did it actually find trouble? Going below at this location. Why? Initially, during this particular down move, large position was placed here. And then during breakout, easily this large delta area was taken out by price. So if there was a large position earlier here, to take it out, you would need an equal show of aggression from the opposite party. So for all intents and purposes, during this breakout here itself, this guy would have placed a large order, and he is doing his job of defending at this location. Do not look at delta, positive delta as green and negative delta as red. See where price is. If you don't want to get confused, I'm giving you a tip. If you follow this tip and use delta profiles, you will be the happiest guy. Change everything to one color. It's price plus volume. It's not just volume or it's not just price. Clear? Just because you see a large green delta bar doesn't mean that you are going to buy into the market. Just because you see a large red delta number doesn't mean you are going to sell into the markets. Delta doesn't work that way. There is a whole other way of using delta with footprints on a consistently. I'm not talking about that 1-2 cases. I'm talking about on a consistent perspective, on a where you can actually rely on that metric on a day in and day out perspective. Is it possible to draw delta divergence profile volume delta? No, no. Please don't. I am one of those who's personally very against delta divergence. Any divergence will give you a larger possibility of losing money. पहले RSI divergence पे खेल के traders used to use money. Now they are trading on delta divergence and using money, losing money. But divergence as a whole, there has to be a strong framework there. Basically, let's not get into that. If you want to have much more clarity, you can also do the same exercise. Use your delta profiles on a 30 minutes price range. I wouldn't suggest to go beyond 30 minutes if you are a day trader, and because then the whole purpose of finding those good locations where you can take a trade on an intraday basis gets negated for you if you go on a daily time frame or on a weekly time frame there. Sure, they are important areas, but price reaction need not compulsorily occur on intraday basis only. Let's remove step profile. Let's look at Nifty. Now, all we are seeing here to a good extent is consolidation and up move. For example, let us say for the coming few days, forget everything else. If you are a price-based trader and you want to use volume analysis, say this is the range of from 14th to 18th. This is your most recent pivot low on 14th, and this is your high on 18th. Go to delta. Sorry, let's go to 200. 200 tick size for Nifty is ideal. So focus on these price locations that delta is actually telling you. For example, you're seeing a high delta volume area. Is that clear? Everyone. You can also use it on a larger price structure. If you are a positional trader, you can use it on a larger price structure if you want. But the whole purpose of using delta profiles and using and tracking the 2-week balance rule that I explained you, is that clear? Do we have any questions on what was explained so far? Roshan, did you see any questions?
You can have a just go through the Q&A section as well. Some of them have asked some questions.
Yes. It almost coincides with volume notes, right? Right. Can this be applied on stock? Right. It's basically delta charts. Use if you want to start using profiling, then I would suggest start with delta profiles. It is easier to understand. You need not understand the value area rule or the various profile structures, or let's say the closing price closing relationship to the volume profile, but you can simply plot delta profile and look at. Can you please show how to do it? Just go to custom profile and plot it from the most recent pivot low to the pivot high. Oh, sorry. And here in buy sell volume, choose delta. I'm personally using 200 tick size since this is on a larger price range here. Can you please share analysis techniques from a non-directional point of view, like know which days to avoid? From an intraday non-directional trader, do you mean that? Yes. Provide recording? Yes, Quantower, I think, would provide it. In Bank Nifty futures, would you consider shorting only below 45,200 value area high? Correct. Can this be applied on stocks like Reliance or Unilever? Definitely, you can use it on any instrument that has volume, basically. How do you know if it's a breakout or a fake out? As I explained some time back, you can always understand that using the previous day's profile structure with the closing. That will give you quite some clarity. In the morning, volume profile is not mature, then what will you prefer? That's why I said I always look at the previous period's profile, like the previous week's profile, previous day's profile, for example. How to visually identify value area of previous day? The software shows that the darker area is your value area, basically. Profile with buy sell volume is better or simple volume is better? Buy sell volume is just a way to visualize the volume, but there is nothing magical or special about it, if you ask me. Okay, other questions addressed? Those are trading on market profile. Is it necessary to understand or need of volume profile? I do not use market profile, so I cannot comment on that. If as a market profile practitioner, do you need to use volume profile or not? Any other queries?
There was the question regarding the non-directional. Yash was talking about on an intraday basis. So if you could answer.
On an intraday basis, honestly, I am not one to trade a lot on a non-directional basis on an intraday basis. A couple of pointers that I can tell you with respect to non-directional trading on an intraday basis is, for example, on any day or any week, for example, I spoke about the 2 weeks balance rule, right? The previous week and the week before that in Bank Nifty, you saw that it was a balanced week. When you have a 2 week balance rule, then it is not ideally recommended that you carry a non-directional, you open a fresh non-directional position, sorry, for the current week, especially if volatility is coming down, because market has already been in balance for 2 weeks. Then there is a good chance we can see the start of a trending move. Say you are ready to put up with the risk and you want to open a non-directional position, have a very strict rule of the previous week's high and the previous week's low that I had mentioned. Because as a non-directional trader, one of the most important points is not knowing when to make adjustments, but when to actually close the entire trade itself. And when you say, for example, traders who packed up their positions at 45 280 or 45 200 would be in a much better position than the ones who are still holding onto the trade here. Does this apply to non-balanced weeks and then balance? Only when you see the previous week's balance, the previous 2 weeks are from a balance structure. Apart from that, what you can do is, if you see that on any particular day the markets are closing at a particular range, and then value area is also to the high, the next day towards the direction, if there is a 15 minutes opening range breakout, that is a very good day to avoid non-directional and to go directional. that is a very good day to avoid non-directional and go directional. That is, for example, this is your 15-minute start of Nifty. When you see an opening range breakout this way, that is when you need to pack up your non-directional position. If there is a breakout failure when price comes back again into the range this way, that is when you can redeploy a non-directional position. Is that clear? Other than that, good days to trade to enter non-directional positions is if the previous day has a balanced structure this way with a negation of previous day's high and a previous day's low, for example. Again, but basically, as I said, I'm not a great fan of trading non-directional on an intraday basis. It is much more fruitful on a positional basis. On intraday, it becomes a little too messy, but again, that's my personal opinion. Clear? All right. Before we close, I would like, as I said, I am a professional trader. I would like to share a couple of important announcements with you. I share my proprietary indicators and also mentor interested students on a monthly basis and also give up subscription for my own proprietary indicators. For example, I mainly use three tools, that is delta bands, optics and velocity metrics. They are based on various principles of volume profile, order flow data, momentum, and a lot of other things. They are basically to identify the market direction in a much more clear and a refined way that provides much more valuable insights than traditional volume profile and order flow. Optics is used to understand where the markets are trending and where the markets will not be trending, which is essentially avoiding trades. For example, UB1 and LB1 are references basically where market will move every day just to find some liquidity, and unless price goes beyond this area, directional trades, trend following trades are not recommended. So these are, we use multiple tools for multiple reasons. They are leading indicators developed in-house and they are offered on a subscription basis as indicators only, and also offered as a part of volume profile and order flow mentorship. Interested people can visit my website killertrader.in, and here you will see that the details of the mentorship program and the indicator suite. Depending on your requirement, you can subscribe. Uh, I will also be sharing my Telegram ID and the link to this site so that you can reach out to me if you have any questions. Thank you all for the joining this session. I hope it was informative and you got to learn something new. Make sure to use it regularly, practice and make notes, and ask me questions anytime you have queries. I'll make sure that my uh, details are shared. Basically, my Telegram contact details are shared so that you can reach out to me. The website URL is killertrader.in.
Yeah, so I think all of you I've got a lot of insight on what volume profile is all about and how to make use of this. So you can, those who are new to Quantower, you can download the software. You get a 5-day live market demo with all the features that is available in Quantower, excluding KT indicators. So that is something that is not possible in the demo. So if you want any of these indicators that are available in Quantower under the name Quantower KT Indicator Suite, so you can contact Abhishek directly and find out how you can get the access to it. If you have any questions regarding Quantower software, our one-point support contact is on via WhatsApp. You can message us there. Our WhatsApp number is 7400007515. I've already put that on the chat, so I'll repeat again: 7400007515. So if you have any questions there, you can message us there and we will answer as quickly as possible. Thank you all for attending this webinar. And thank you, Abhishek, for taking time and giving us a valuable insight on volume profile.
Thank you, Roshan. Thank you all. And please make sure to leave your feedback. It will really help.